Warren Buffett became a millionaire before he became famous. Not a billionaire, not the Oracle of Omaha, a millionaire. And he did it by age 32. What's fascinating isn't the amount. Today, $1 million might not sound life-changing compared to the fortunes we hear about on social media. What's fascinating is how he did it. No startup, no viral app, no inheritance, no lucky crypto trade. In fact, Buffett's path to his first million was so boring that most people would have quit long before getting there. But hidden inside that journey is a blueprint that eventually created one of the greatest fortunes in human history. And by the end of this video, you'll understand the exact sequence of decisions that transformed a kid selling chewing gum in Omaha into a millionaire investor, and why his first million was actually much harder to earn than the next 100 billion. Before we begin, a quick challenge. As you're watching, ask yourself this question. Would you have had the patience to do what Buffett did? Most people think they would. Almost nobody actually does. Let's trace the money. The obsession begins. Long before Warren Buffett made his first $1 million, he was obsessed with making money. At age 6, he was buying packs of Coca-Cola and reselling individual bottles for a profit. He sold chewing gum door to door. He delivered newspapers. He sold golf balls. He even placed pinball machines in barber shops. While most kids were spending money, Buffett was measuring, tracking, and reinvesting it. By the time he was a teenager, he had already accumulated thousands of dollars. At 14 years old, he used savings from newspaper routes to purchase farmland in Nebraska. Think about that. Most 14-year-olds worry about homework. Buffett was buying income-producing assets. But despite all these entrepreneurial ventures, they weren't what made him a millionaire. The real breakthrough came from an idea he discovered in a book that would completely change his life. A mentor. In the late 1940s, Buffett discovered The Intelligent Investor by Benjamin Graham. To Buffett, it wasn't just a finance book, it was a revelation. Graham argued that stocks weren't lottery tickets. They were pieces of real businesses, and sometimes the market priced those businesses incorrectly. If a company was worth $100 but the market sold it for $50, an investor could buy it with a margin of safety. Simple, logical, powerful. Buffett became obsessed. He eventually studied under Graham at Columbia Business School and later worked for him at Graham-Newman Corporation. This is where Buffett learned something that would become the foundation of his fortune. Don't follow the crowd. Buy value. Wait patiently. Repeat. Simple in theory. Extremely difficult in practice. And soon Buffett would have the chance to test that philosophy on his own. The $100 partnership. In 1956, Benjamin Graham retired. Buffett returned to Omaha. He was just 25 years old. At that point, his personal net worth was already substantial for his age, but he was nowhere near a millionaire. That's when he launched what would become the vehicle for his first million, Buffett Partnership Limited. The beginning was surprisingly small. The partnership started with 7 limited partners, mostly friends and family. Together, they invested just over $100,000. And here's the incredible part. Buffett himself contributed only $100 of capital. Not $100,000. $100. His real contribution wasn't money, it was skill. He structured the partnership so that investors kept most of the profits, while he received a share of the gains above a certain threshold. If he performed well, he got paid. If he didn't, he earned very little. In other words, Buffett put his reputation on the line, and investors loved it because his interests were aligned with theirs. Now here's where the story gets interesting. Most fund managers diversify broadly. Buffett didn't. He concentrated his bets. When he found opportunities that met his criteria, he invested heavily, sometimes very heavily, and the results started attracting attention. returns that changed everything. From 1957 through the early 1960s, Buffett's partnerships generated extraordinary returns. Year after year, they significantly outperformed the market. Investors who entrusted money to him saw their capital grow rapidly. But Buffett wasn't spending those gains. He wasn't buying yachts. He wasn't buying mansions. He wasn't trying to look rich. He was reinvesting. Every dollar earned became another worker in his financial army. And that's where most people misunderstand the story. Buffett didn't make his first million through one spectacular investment. He made it through relentless compounding. Profits generated more profits. Those profits generated even more profits. The snowball was starting to roll downhill. And then came the milestone. By 1962, Buffett's investment partnerships had grown to approximately $7.2 million in assets, and Buffett's own share exceeded $1 million. At age 32, Warren Buffett officially became a millionaire. But here's the twist. For Buffett, the $1 million wasn't the destination. It was merely proof that the machine worked. And that's when he made a decision that would change financial history. If you're enjoying this investigation into how great fortunes are actually built, not the myths, but the real mechanics behind them, consider subscribing to BillionTrace, because the stories behind wealth are often far more surprising than the wealth itself. Now back to Buffett. A strange purchase. The year Buffett became a millionaire, he started buying shares in a struggling textile company called Berkshire Hathaway. At first, this wasn't supposed to become his life's work. It was simply an undervalued stock, classic Buffett. The company was worth more than the market believed. So he bought shares, then more shares, then even more. Eventually, he gained control. Many people assume Berkshire Hathaway made Buffett his first million. That's not true. He was already a millionaire before Berkshire became the empire we know today. In fact, Buffett later called the original Berkshire investment one of his mistakes. The textile business itself wasn't attractive. But ownership of Berkshire gave him something much more valuable: a platform, a vehicle through which he could acquire better businesses. And that single decision would eventually turn millions into billions. But that's a story for another day. The key point is this: Buffett's first million wasn't created by Berkshire Hathaway. It was created before Berkshire through disciplined investing, patient compounding, and exceptional capital allocation. Why most people fail. At this point, you might be thinking, okay, Buffett found undervalued stocks and held them. Sounds easy. It isn't. Because the real challenge wasn't intelligence, it was behavior. Imagine watching others chase hot stocks while you're buying boring companies. Imagine waiting years for the market to recognize value. Imagine looking wrong for long periods. Most investors can't handle that. Buffett could. He once described investing as transferring money from the impatient to the patient. His first million wasn't built on predicting the future. It was built on refusing to react emotionally. And that lesson remains just as relevant today as it was in the 1950s.
The million that created billions. Now here's the most important part of the story. Buffett's first million was not his greatest achievement. It was his most important achievement. Because once the first million existed, compounding could work on a larger base. A 10% return on $10,000 is nice. A 10% return on $1 million is very different. The larger the snowball becomes, the faster it grows. That's why the majority of Buffett's fortune was accumulated decades after he became a millionaire. The first million was the hard part. Everything that followed was the multiplication of a process that had already been proven. The lesson isn't that Buffett had some secret formula. The lesson is that he started early, stayed disciplined, and allowed time to do most of the work. When people look at Warren Buffett today, they see one of the richest investors in history. They see Berkshire Hathaway. they see hundreds of billions of dollars. But those numbers hide a much simpler story: a kid selling Coca-Cola, a teenager buying farmland, a student discovering Benjamin Graham, a 25-year-old launching a partnership with 7 investors, a disciplined investor compounding capital year after year. That's how Warren Buffett made his first million. Not through a miracle, not through a shortcut, but through a process. And perhaps that's why his story remains so powerful. Because while very few people will become Warren Buffett, anyone can understand the principles that created his first million: patience, discipline, value, and time. Lots of time. If you made it all the way to the end, here's a question. Do you think Warren Buffett could still make his first million from scratch in today's world? Let us know in the comments. And if you'd like to see the next chapter, the incredible story of how Berkshire Hathaway transformed that first million into one of the greatest fortunes ever recorded, subscribe to BillionTrace, because every fortune leaves a trail, and we're here to follow it.